I am Jesse Livermore, the man who made and lost more fortunes than perhaps any trader in history. They call me the Boy Plunger and the Great Bear of Wall Street, names I earned by making millions shorting the market during the crashes of 1907 and 1929. What I'm about to teach you about emotional control in trading isn't theory. It's what allowed me to extract $100 million from the markets, equivalent to over $1.5 billion today, and also what led to my dramatic downfalls. The market is an emotional roller coaster designed to separate you from your money. I know this better than anyone. I've climbed to the pinnacle of wealth 4 separate times, only to lose everything again. My greatest strength and most devastating weakness was always the same thing: my emotions. When I was just 14 years old, I made my first trade with $5 in a bucket shop in Boston. I turned that into $1,000 in short order. The rush I felt was indescribable. That feeling, that high, would become both my greatest asset and my ultimate undoing. I chased it throughout my life, riding waves of euphoria during winning streaks and crushing despair during losses. Let me be crystal clear. Your emotional state will determine your trading success more than any system, strategy, or market knowledge. I developed trading rules that made me millions, but when I broke them due to emotional impulses, I lost everything, every single time. In 1907, I sensed market weakness and held my short positions while panic spread through Wall Street. My emotional discipline made me $3 million in a single day. In 1929, I did the same, walking away with $100 million when the market collapsed. But after each triumph, my emotional guard weakened. Success bred arrogance. Arrogance bred deviation from my rules. Deviation bred catastrophic losses. I felt the cold sweat of watching millions evaporate in minutes. I've experienced the hollow feeling in my stomach when I realized I'd broken my own trading rules. I've known the crushing weight of debt after losing fortunes. And ultimately, I experienced the complete despair that led me to take my own life in 1940. My emotional journey through the markets cost me everything: my wealth, my relationships, and eventually, my life. The irony is that I understood the solution. In my trading journal, I wrote, "There is nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. The market doesn't care about your feelings. It doesn't reward your hopes or punish your fears. It simply transfers money from the emotionally undisciplined to the emotionally controlled. I made millions when I maintained emotional discipline and lost millions when I abandoned it. The emotional roller coaster destroyed me because I couldn't maintain the discipline I knew I needed. Learn from my tragic end. Master your emotions, or they will master your trading account." That's not philosophy. It's the most expensive lesson I ever learned. I am Jesse Livermore, and I've made and lost more fortunes than most traders will see in 10 lifetimes. In 1929, I made $100 million shorting the market crash. That's $1.5 billion in today's money. My first rule of trading is simple yet profound. There's nothing new under the sun. The patterns that made me rich a century ago are the same patterns you'll see tomorrow morning when the markets open. When I began trading in the bucket shops of Boston at 14 years old, I quickly realized that price movements weren't random. They repeated again and again. The market has no memory, but human nature never changes. Fear, greed, hope, and ignorance drive prices today, just as they did when I first stood before the quotation board in 1891. I've studied thousands of charts across my career, and I can tell you with absolute certainty that pattern recognition is the foundation of all profitable trading. I don't care what fancy name they've given these patterns today: head and shoulders, cup and handle, flags, pennants. I was trading these formations decades before they were categorized and labeled. Let me tell you something crucial. I never bought or sold based on why something should go up or down. The reasons don't matter. The action of the market itself tells the real story. When I saw U.S. steel breaking to new highs with increasing volume in 1907, I didn't need to know about their new production methods or profit margins. The price action told me everything. My method was to identify the line of least resistance and position myself accordingly. When I saw stocks making new highs after a consolidation period, I bought. When I saw them making new lows after a period of support, I sold. It sounds simple because it is simple. The difficulty isn't in understanding. It's in execution. I made $3 million in a single day during the 1907 panic by recognizing the same patterns I'd seen in previous downturns. While others panicked, I remained calm because I'd seen this movie before. The actors change, the specific events change, but the plot remains the same. You must understand that markets don't create new patterns. They simply repeat old ones with different actors. The internet bubble of 2000? I saw the same pattern in radio stocks in the 1920s. The housing collapse of 2008? No different from the real estate crashes I witnessed in my time. My biggest losses came when I forgot this rule. When I convinced myself, this time is different. It never is. The scale may change, the securities may change, but human nature remains constant. And human nature is what drives markets. So burn this into your mind. Study the patterns. Learn to recognize them. Don't waste time predicting the future. Simply recognize the present for what it is, a repetition of the past. This is how I made millions while others lost everything. This is how you'll survive when others don't. Rule number 2, patience is profit. That's what I've lived by throughout my trading career. I am Jesse Livermore, and I've made and lost millions multiple times in the markets. My second most critical rule is that patience isn't just a virtue. It's literally where the profit comes from. Let me teach you my waiting game that turned me into one of Wall Street's greatest traders. I don't chase trades, ever. When I was a young man working the bucket shops of Boston, I learned that rushing into positions is the amateur's downfall. I've watched thousands of traders destroy themselves by feeling they must always be in the market. I don't. Sometimes the most profitable position is no position at all. In 1907, I made $3 million in a single day shorting the market during the panic. But what most don't realize is that I'd been watching, waiting, building my thesis for months before executing. I didn't just get lucky. I positioned myself through disciplined patience. The money was made in the waiting, not just the execution. My strategy is simple but brutally difficult to follow. I wait for the perfect setup where all factors align. I look for what I call the line of least resistance in a stock or commodity. When price, volume, market sentiment, and sector strength all point in the same direction, that's when I strike, not a moment before. I've developed specific waiting triggers in my career. First, I watch for a stock to make a new high. Then I wait again. I don't buy immediately. I wait to see if it pulls back and holds above previous resistance. Only when it resumes its uptrend do I enter. This patience has saved me from countless false breakouts. that trap eager traders. In 1929, I made $100 million shorting the market crash. But what's not widely understood is that I began building those positions in 1928. I saw the signs of excess, the dangerous margin levels, the euphoria. I waited, sometimes painfully, watching others make money while I prepared my position. My patience was eventually rewarded many times over. The hardest lesson I've learned is that markets require different types of patience. Bull markets test your patience by making you want to take profits too soon. Bear markets test your patience by making you want to average down on losers. I've fallen victim to both and paid dearly. My waiting game isn't passive. It's intensely active observation. I study charts, volume patterns, and market behavior daily. I'm not waiting blindly. I'm gathering intelligence. Every day I don't trade is a day I become better prepared to execute when conditions are right. Remember this: the market will test your patience more than any other quality. It will seduce you to act when you should wait and paralyze you with fear when you should act. I've made my greatest fortunes by waiting for the big moves and avoiding the daily noise that consumes most traders. Patience isn't just about restraint. It's about striking with absolute conviction when the time is right. I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetimes. When people speak of my greatest skill, they often mention my timing or my ability to read market sentiment. But let me tell you something crucial. The single most important rule that kept me alive in the markets was my courage to cut losses. This painful lesson cost me millions to learn, but it will cost you nothing if you truly listen to what I'm about to share. I remember the day in 1929 when I made $100 million shorting the market before the crash. What most don't realize is that this success came after I'd already lost everything, not once, but several times. My greatest trades were born from my greatest failures. The market taught me through pain what no book ever could. In 1908, I was wiped out completely, not because I couldn't read the market, but because I refused to accept a small loss. I clung to my position, watching it deteriorate day after day, telling myself the market would turn. It never did. My stubborn pride cost me my entire fortune. That lesson was seared into my soul with the hot iron of financial ruin. Here's what I learned. The market doesn't care about your opinion. It doesn't care what you paid for a stock. It doesn't care about your hopes or your theories. The market is always right. When you fight the market, you will lose. Every single time. I developed a rule after that disaster. Cut losses at 10%. No exceptions, no hesitation, no second guessing. When a position moves against me by 10%, I exit immediately. This isn't about being right or wrong. It's about survival. I'd rather take 10% losses than one 100% loss. The mathematics of loss recovery are brutal and unforgiving. Let me be crystal clear about something most traders never understand. A 50% loss requires a 100% gain just to break even. A 90% loss requires a 900% gain to recover. These aren't just numbers. They're the reason most traders fail. They let small losses grow into catastrophic ones, then spend years or decades trying to climb out of holes they dug themselves. I've seen brilliant men reduced to nothing because they couldn't take a small loss. Their intellect, their market knowledge, their sophisticated theories, all worthless because of this one fatal flaw. I was one of them until I wasn't. When I cut a loss, I don't see it as failure. I see it as paying a small premium for information. The market has told me I'm wrong, and I listen. This discipline is what allowed me to survive long enough to make my greatest trades. Remember this. In trading, your first loss is your best loss. The longer you wait, the more expensive the lesson becomes. I paid millions for this wisdom. You can have it for free if you have the courage to follow it. Cut your losses. Protect your capital. Live to trade another day. This isn't just advice. It's the difference between survival and extinction in the markets. I am Jesse Livermore, and patience is what separated me from the amateurs who lost everything. My fortune wasn't built on quick trades or gambling instincts. It was built on waiting. I made over $100 million in today's dollars because I mastered the art of patience, something most traders never learn until it's too late. When I look at a chart, I don't immediately jump in. I wait. I watch. I observe the market's rhythm like a hunter tracking prey. Most traders I've known over my decades in the market rush in at the first sign of movement. But I've always understood that the market rewards those who can sit still when everyone else is frantic. Let me tell you exactly how my patience principle works. I don't act until I see what I call a pivotal point, a clear signal that the market's direction has been confirmed. In 1907, during the banking panic, I watched for weeks as stocks declined. The newspapers were filled with panic. Brokers were calling me constantly with opportunities, but I simply waited. I waited until Union Pacific showed me the confirmation I needed. 3 consecutive days of higher lows with increasing volume. Only then did I commit my capital. That patience turned $10,000 into over $300,000 in just 2 months. I've learned through painful experience that entering too early is far more dangerous than entering too late. In 1908, I lost nearly everything because I jumped into cotton before my signals were confirmed. The market looked ready to break. All the experts were bearish, and I couldn't resist the temptation. That impatience cost me my fortune. The market doesn't care about your opinions or your timeline. It moves when it's ready, not when you are. My rule is simple. I wait for the market to confirm my thesis before I commit a single dollar. If I believe copper will fall, I don't short it immediately. I wait until it actually starts falling. Then I join the trend. I miss the first 10% of the move, but I catch the middle 80%, which is where the real money is made. The first and last parts of any move are the most dangerous. Leave those scraps for the gamblers. When you feel the burning urge to trade, that's precisely when you should sit on your hands. I keep a journal beside me where I write, "Wait for your number." This reminds me that trading opportunities are like streetcars. Another one comes along every few minutes. Missing an opportunity costs nothing, but entering a bad trade costs everything. My greatest trades, shorting the market before the 1929 crash, catching the wheat bull market of 1925, all came after periods of intense patience. I would sit for days, sometimes weeks, doing nothing but watching. The average person cannot stand inactivity, but the professional trader thrives in it. Remember this. Your edge isn't in your ability to buy and sell. It's in your ability to do nothing until the perfect moment arrives. I am Jesse Livermore, and I made and lost more fortunes than most traders will ever experience in their lifetimes. My second cardinal rule, perhaps the most important of all, is what I call the emotional detachment method. This system saved me from ruin countless times and enabled my greatest market coups. When I made $100 million shorting the 1929 crash, it wasn't luck. It was emotional discipline. Let me be absolutely clear. The market doesn't care about your hopes, your dreams, or your financial obligations. I learned this lesson through devastating losses that bankrupted me multiple times. Emotions are the greatest enemy of any trader. Fear and greed will destroy your account faster than any market crash ever could. My method for emotional detachment begins with a simple ritual. Before I place any trade, I remove myself from the outcome. I don't think about the yacht I'll buy if I'm right or the humiliation I'll face if I'm wrong. The trade is nothing but a mathematical proposition. Either the probabilities favor my position or they don't. In 1907, during what they called the banker's panic, I maintained this emotional distance while others lost their minds. While men were literally jumping from windows, I methodically executed my short positions. The result? I walked away with $3 million, equivalent to over $80 million today. Not because I was smarter, but because I remained emotionally detached when everyone else was consumed by panic. Here's how I implement emotional detachment in practical terms. First, I never risk more than I can afford to lose on any single trade. This isn't just prudent money management. It's psychological warfare against your own emotions. When you're overly exposed, fear clouds judgment. I've seen brilliant men make catastrophic decisions because they had too much on the line. Second, I write down my trading thesis before entering any position. This creates an objective record that can't be manipulated by my emotions later. When the stock moves against me and my mind starts creating excuses, I simply return to my written thesis. If the original reason for the trade is no longer valid, I exit. Period. No hope, no rationalization. Third, I never celebrate wins or mourn losses for more than a moment. Both reactions create dangerous emotional attachments to outcomes. After my greatest victory shorting the 1929 crash, I didn't throw a party. I simply recorded the trade in my journal and began looking for the next opportunity. Emotional neutrality is your greatest asset. The hardest lesson I've learned is that trading isn't about being right. It's about making money. My ego has cost me millions by keeping me in losing positions too long. Remember, the market doesn't know you exist. It won't apologize for taking your money or reward you for your brilliance. It simply is. Your emotions are irrelevant to its movement, so keep them out of your decisions. Master emotional detachment, and you've mastered half the battle of trading. Fail at this, and nothing else I teach you will matter. I am Jesse Livermore, and I made and lost more fortunes than most traders will ever see in their lifetimes. My third rule, what I call the loss acceptance protocol, is perhaps the most painful lesson I ever learned, and it cost me millions before I truly understood it. When you lose money in the market, you haven't just lost capital, you've purchased information. Expensive information, yes, but potentially invaluable if you're wise enough to use it. The market taught me this lesson repeatedly until I finally accepted it. In 1907, I made $3 million shorting the market during the panic. By 1908, I'd lost it all because I refused to accept my losses quickly. I was too proud, too stubborn to admit I was wrong. The market doesn't care about your pride. Let me be crystal clear. Losses are inevitable. I've never met a trader who hasn't lost money. The difference between the greats and the forgotten is how we respond to those losses. When I take a loss now, I don't fight it. I don't average down hoping for recovery. I accept it immediately and move on. Here's exactly how my loss acceptance protocol works. First, I establish my risk tolerance before entering any position. I decide precisely how much I'm willing to lose, usually no more than 10% of my capital on any single trade. Second, I place my stop-loss orders and honor them religiously. Third, and most importantly, I conduct a thorough post-mortem on every significant loss. During these post-mortems, I ask myself, what did I miss? Was this a failure of analysis or execution? Did I break my own rules? Was I trading on emotion rather than logic? I write down these answers in my trading journal, a practice I've maintained for decades. In 1929, I made $100 million shorting the market during the crash. Yet by 1934, I'd lost it all again. Why? Because I still hadn't fully embraced this protocol. I would accept small losses, but when facing potentially catastrophic ones, I froze. I couldn't pull the trigger. I kept hoping the market would turn in my favor. It didn't. The market doesn't reward hope. It rewards discipline. My biggest revelation came when I realized losses contain more valuable information than wins. When you win, you might attribute it to skill when it was luck. When you lose, the market is sending you a clear message. Listen to it. I've trained myself to feel a sense of accomplishment when I cut a loss quickly. It's counterintuitive, but it's transformative. I celebrate the discipline of taking that loss because I know it's protecting my capital for better opportunities. Remember this. The loss you refuse to take today will be much larger tomorrow. I've paid millions to learn this lesson, so you don't have to. The loss acceptance protocol isn't just about surviving and trading. It's about maintaining the psychological capital necessary to thrive. Accept your losses quickly, learn from them thoroughly, and move forward decisively. This is how I've survived decades in a game that destroys most who play it. I am Jesse Livermore, the man who made and lost several fortunes in the early 20th century markets. I've taken $10,000 and turned it into $10 million, then lost it all and done it again. My fourth rule, what I call the scale-in discipline, is perhaps the most crucial weapon in my arsenal for managing risk while maximizing profits. This isn't theory. It's what allowed me to extract millions from the 1907 and 1929 crashes while others lost everything. When most traders enter a position, they commit their entire intended capital at once. I never do this. Never. It's financial suicide. I've learned through devastating losses that scaling into positions gradually is the difference between survival and destruction in this game. Here's exactly how my scale-in discipline works. I never risk more than 2% of my capital on the initial position. If the market confirms my thesis by moving in my direction, I add to my position. If it moves against me, I have capital preserved to either average down or pursue other opportunities. This approach saved me during the panic of 1907 when I initially shorted Union Pacific, added as it fell, and walked away with over $3 million, equivalent to about $90 million today. My scale-in method follows three precise steps. First, I enter with a pilot position, small enough that being wrong won't hurt me significantly. Second, I add to winners only after the market confirms my thesis with price action. Third, I increase position size geometrically, not arithmetically, as confirmation strengthens. Let me be absolutely clear about something. Scaling in doesn't mean averaging down on losers. That's how I lost my first fortune. When I was younger, I doubled down on losing positions out of pride and stubbornness. The market humbled me repeatedly until I learned this lesson in blood. In 1929, while the public was buying stocks with borrowed money at the top, I was scaling into short positions. I started small, but as the market began to crack, I increased my positions methodically. By the time of the crash, I had built a massive short position that netted me around $100 million in today's dollars. The psychological advantage of my scale and discipline cannot be overstated. When you commit everything at once, every tick against you creates anxiety. This emotion leads to poor decisions, cutting winners too soon and holding losers too long. By scaling in, I maintain mental clarity. I know I have ammunition in reserve. This creates patience and precision. Remember this: the market will test your conviction repeatedly. By scaling in, you're never fully exposed to being catastrophically wrong. I've been wiped out multiple times in my career, but each time it was because I abandoned my own disciplines. The scale and discipline isn't just about risk management. It's about maximizing returns by having capital available to press your advantage when the market confirms you're right. This is how fortunes are made, not by gambling everything on a single idea, but by methodically building positions as the market validates your thesis. I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetime. The market has been my battlefield for decades, and I've paid for my education in blood. Today, I'm going to share with you one of my most sacred rules, one that could have saved me millions had I followed it religiously. Never average down on losing positions. When I was a young trader on Wall Street, I believed I could outsmart the market. I thought that if a stock dropped after I bought it, purchasing more at a lower price would improve my average cost basis. This delusion cost me everything more than once. In 1908, I lost my first $1 million fortune partly because of this mistake. By 1915, I'd rebuilt my wealth to $5 million only to lose it again through the same error in judgment. I learned this lesson the hard way, so you don't have to. When you average down, you're not being strategic. You're being emotional. You're refusing to admit you were wrong. I've watched countless traders destroy themselves with this single mistake. Let me be absolutely clear. A losing position is the market telling you that your analysis is flawed. When I see red in my portfolio, I don't see an opportunity to buy more at a discount. I see a warning signal. The market is screaming at me that my timing or thesis is wrong. In 1929, I made $100 million shorting the market during the crash because I respected this principle. I didn't fight the trend. I didn't average down on losing longs. I recognized the direction of the market and positioned myself accordingly. Here's what happens when you average down. You increase your risk exposure to a proven loser. You tie up more capital that could be deployed elsewhere. Worst of all, you create psychological handcuffs. The more money you sink into a failing position, the harder it becomes to exit. Your ego becomes entangled with the trade. I've developed a concrete alternative. Instead of averaging down, I cut my losses quickly and look for new opportunities. If I'm truly convinced about a stock's potential, I wait for it to prove itself by establishing a new uptrend before re-entering. The market will give you plenty of chances to make money, but only if you preserve your capital. Remember this: the first loss is the smallest loss. In 1923, I ignored my own rule and averaged down on cotton. What began as a manageable position grew into a monster that eventually cost me $3 million. Had I simply accepted that initial small loss, I would have preserved my capital for the genuine opportunities that followed. My success came not from being right all the time, but from managing my losses when I was wrong. The professional trader's edge isn't in finding winners. It's in controlling losers. I've watched amateurs turn small, manageable losses into account-destroying catastrophes by averaging down. This isn't theory. This is what separated me from the thousands of failed traders who came to Wall Street with the same dreams I had. Never average down on losing positions. Your survival in this game depends on it. I am Jesse Livermore, and I've made and lost more fortunes than most traders will ever see in their lifetime. When I was at my peak, I had amassed over $100 million in today's money, and I did it by following rules that I carved into my mind through painful losses and exhilarating victories. Today, I'm going to teach you one of my most sacred principles. Rule number 3. Trade with the market's trend, not your opinion. This rule saved me from ruin countless times. Let me be absolutely clear. Your opinion about where a stock should go means nothing. The market doesn't care what you think. I learned this lesson the hard way in 1907 when I almost went against my own instincts during the banking panic. I had been short Union Pacific, and my position was profitable. My analysis told me the stock should continue falling, but suddenly it stabilized. My opinion said stay short, but the market action said otherwise. I closed my position against my personal conviction, and thank God I did. Had I stubbornly clung to my opinion, I would have been wiped out when J.P. Morgan orchestrated a market rescue that sent stocks soaring. I've watched thousands of traders destroy themselves by fighting the tape. They develop a theory about why a stock should fall, then throw good money after bad as it rises against them. I never do this. Never. When I see the market moving against my position, I don't argue with it. I exit. The way I trade, I don't care if a stock should be worth $10 or $100 based on fundamentals. What matters is only one thing. Which way is it moving? If it's going up, I want to be long. If it's going down, I want to be short. Everything else is intellectual masturbation. Here's my method. I identify the primary trend using price action alone. In 1929, before the crash, I observed stocks making lower highs and lower lows, a downtrend forming. While the newspapers were still bullish and the public was buying, I saw the truth in the price action and positioned myself short. My opinion didn't matter, only what the market was actually doing. I made $100 million in today's dollars during that crash by following the trend, not fighting it. When you trade with the trend, you're swimming with the current instead of against it. I look for stocks making consecutive higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. Then I enter only when the price confirms the trend is continuing. I've survived multiple market crashes and panics by respecting this rule. In 1907, 1929, and other major downturns, I preserved my capital and often profited enormously because I traded what the market was doing, not what I thought it should do. Remember this, the market is always right. Your job isn't to prove your intelligence by predicting where prices should go. Your job is to recognize where they are going and align yourself accordingly. This simple rule has made me millions, and it can do the same for you if you have the discipline to follow it. I am Jesse Livermore, and I've made and lost more fortunes than most traders will see in 10 lifetimes. When people ask me how I became one of the greatest traders in Wall Street history, I tell them the truth. I mastered one fundamental rule that separates winners from losers. Rule number 4: cut your losses quickly and let your winners run. This principle made me millions during the panic of 1907 and the crash of 1929 when I shorted the market. I didn't succeed because I was smarter than everyone else. I succeeded because I followed my own rules with iron discipline. Let me tell you something about the market that took me decades to truly understand. The market doesn't care about your opinions or feelings. I've watched countless men enter the market with confidence and leave broken because they couldn't accept being wrong. Their pride cost them everything. When I place a trade and it moves against me, I exit immediately. I don't hope. I don't pray. I don't average down. I get out. Period. In 1907, I would have lost my entire fortune if I hadn't cut my losses when the market first turned. Instead, I preserved my capital and positioned myself to profit enormously when the real crash came. The second part of my rule is equally crucial. Let your winners run. Most traders do exactly the opposite. They hold their losers hoping for recovery and take quick profits on their winners. I call this picking up nickels and dimes while waiting for someone to drop an anvil on your head. In 1929, I maintained my short positions for months as the market collapsed. My colleagues called me crazy when I refused to take profits early. But I saw the trend, and I rode it until it exhausted itself. That single trade made me $100 million in today's money. Here's my method. When I enter a position, I immediately determine my exit point if I'm wrong. Not a penny more. If the trade moves in my favor, I add to my position and move my stop up, locking in profits while letting the position breathe. I never risk my entire fortune on one idea, but when I see a real opportunity, I commit significant capital. I've gone broke several times in my career when I violated my own rules. In 1908, I ignored my stops and held on to losing positions, convincing myself the market would turn. It didn't. I lost everything. The market taught me humility in the most expensive way possible. Remember this: your first loss is your smallest loss. The market will give you unlimited opportunities to make money, but only if you preserve your capital. There's no shame in being wrong. The shame is in staying wrong. When you cut losses quickly and let winners run, you're not just following a trading rule. You're adopting a philosophy of survival. And in this game, the survivors are the only ones who get to keep playing. This principle has made me millions, and it can do the same for you if you have the discipline to follow it without exception. I am Jesse Livermore, the man who made and lost more fortunes than perhaps any other trader in history. Rule number 5 in my trading system is one that cost me millions to learn. Develop unwavering emotional consistency. This single principle separates the amateurs from the professionals, and I paid dearly to master it. When I began trading, I was a slave to my emotions. The market would surge, and I'd feel invincible, buying more than my system dictated. Then it would crash, and panic would grip me, selling at the worst possible moment. I watched my account balance swing wildly, not because the market was unpredictable, but because my emotions were. In 1907, during one of the greatest market crashes in history, I made $3 million in a single day by maintaining emotional discipline while others panicked. I wasn't smarter than them. I was simply calmer. I had learned to execute my strategy regardless of how I felt. Let me be clear. I don't mean suppressing emotions. I mean preventing them from infecting your decision-making. There's a profound difference. I still feel fear, greed, and doubt. But I've built a system that operates independently of those feelings. My method is straightforward but difficult to implement. First, I document every trade with meticulous detail. Entry point, exit strategy, and most importantly, my emotional state. When I review my journal, patterns emerge. I notice that excitement often precedes my worst losses, while measured caution typically precedes my greatest gains. Second, I never deviate from my position sizing rules. Never. If my system dictates a 2% risk per trade, I take exactly 2%, not 3% when I'm feeling confident, not 1% when I'm nervous. The consistency of position sizing has saved me from catastrophic losses countless times. Third, I create distance between market movements and my reactions. When the ticker tape showed violent swings, I forced myself to wait 30 minutes before making any decision. This simple buffer prevented countless impulsive errors. In 1929, when I correctly predicted the market crash and made $100 million in today's dollars, my emotional consistency was the key. I didn't act on hunches. I acted on my system, regardless of the hysteria around me. My greatest failures came when I abandoned this principle. In 1908, I lost nearly everything because I became emotionally attached to a position. I was right about the direction, but my timing was wrong, and my emotions wouldn't let me exit. I watched millions evaporate because I couldn't maintain emotional consistency. Remember this: the market doesn't care how you feel. It doesn't reward your excitement or punish your fear. It simply moves according to its own logic, and your emotions are irrelevant to its direction. I've learned that trading success isn't about being right more often. It's about maintaining the same disciplined approach regardless of recent wins or losses. Emotional consistency isn't glamorous, but it's the foundation upon which lasting trading success is built. Master this, and you've mastered the hardest part of the game. I am Jesse Livermore, and throughout my tumultuous career in the markets, I've made and lost fortunes multiple times over. What separated my greatest victories from my devastating losses wasn't my intelligence or market knowledge. It was my emotional control. Rule number 3 in my trading philosophy is perhaps the most crucial. Emotional detachment is the difference between consistent profits and financial ruin. When I first entered the bucket shops of Boston as a teenager, I was ruled by emotions: the thrill of victory, the sting of defeat, the paralyzing fear of losing my stake. I watched countless men, some brilliant in their analysis, destroy themselves because they couldn't separate their feelings from their finances. I vowed to be different. I developed a systematic approach to emotional detachment that I'll share with you now. First, I never allowed myself to become personally invested in any position. The market doesn't care about your hopes, your mortgage, or your dreams. I learned to treat each trade as a mathematical equation, not an emotional journey. When I bought United States Steel in 1907 while everyone was panicking, I wasn't being brave. I was being logical. The emotional traders had already fled, creating the perfect opportunity for me to enter. Second, I implemented strict rules around position sizing. Emotion enters when you risk too much on a single trade. I never risked more than 10% of my capital on any position, no matter how certain it seemed. This wasn't just risk management, it was emotion management. With appropriate position sizing, I could sleep at night, think clearly, and execute without the clouding influence of fear. Third, and this was crucial to my success, I kept a detailed trading journal that focused on my emotional states. I documented not just what I bought and sold, but how I felt before, during, and after each trade. This practice allowed me to identify emotional patterns that preceded poor decisions. When I lost millions in the cotton market in 1908, my journal revealed I'd been trading from a position of overconfidence rather than analysis. Fourth, I physically removed myself from the noise. I built my own private office away from the exchange floor where I could think clearly. The constant shouting, the rumors, the panic and euphoria of the trading floor. These are emotional accelerants that cloud judgment. In solitude, I found clarity. Finally, I developed what I call emotional circuit breakers. When I felt anger, euphoria, or panic rising, I would immediately step away from trading. I'd take a walk around Battery Park, sometimes for hours, until my mind cleared. No decision made in an emotional state ever benefited my account. Remember this: the market will test your emotional discipline far more than your analytical abilities. Money won is twice as sweet to most traders as money lost is bitter, and that emotional asymmetry destroys accounts. I made $3 million shorting the 1929 crash, not because I was smarter than others, but because I remained emotionally detached while they panicked. Master your emotions, or they will master your account. Rule number 4, the patience principle, waiting for the pivotal points. I am Jesse Livermore, and I made and lost several fortunes throughout my trading career spanning the early 1900s. My greatest skill wasn't picking stocks. It was identifying what I call pivotal points in the market and having the patience to wait for them. This patience principle is what separated me from thousands of failed traders who constantly churned their accounts into dust. I learned early in my career that most traders lose money not because they lack intelligence, but because they lack patience. I watched countless men rush into positions prematurely, desperate to be in the market at all times. I refused to make this mistake. When I was at my best, I would sit for days, sometimes weeks, doing absolutely nothing until I spotted the perfect setup, what I called a pivotal point. Let me be clear about what I mean by pivotal points. These are moments when the entire market psychology shifts, creating opportunities for massive profits. I'm not talking about minor fluctuations or technical indicators that amateurs obsess over. I'm referring to major shifts in market sentiment that occur perhaps 3 to 4 times a year in any given security. In 1907, during the banking panic, I made my first million by patiently waiting until I saw clear evidence the market was breaking down. While others panicked or tried to catch falling knives, I methodically shorted the market only after confirming the pivotal point had been reached. My patience allowed me to enter with full conviction, using maximum leverage at precisely the right moment. I developed a specific methodology for identifying these pivotal points. First, I watched for a stock to establish a clear trading range. Then I waited patiently for it to approach either the upper or lower boundary of that range. But, and this is crucial, I never acted immediately. I forced myself to wait for confirmation of the breakout or breakdown. Only when the stock clearly penetrated its boundary and showed sustained momentum did I enter my position. This approach required tremendous discipline. I would often sit for hours staring at the ticker tape, fighting my own impulses to act prematurely. The hardest lesson I learned was that doing nothing is often the most profitable decision. When no pivotal points presented themselves, I stayed in cash. I never felt compelled to be in the market. My patience principle isn't merely about waiting. It's about waiting with purpose. During these periods of inactivity, I studied market behavior obsessively. I tracked the stocks I was interested in, noted their reactions to news, and observed their trading patterns. This preparation meant that when pivotal points finally appeared, I could act with both speed and conviction. Remember this: the market will present opportunities to those patient enough to wait for them. Most traders destroy themselves by forcing trades during suboptimal conditions. I made my millions by having the discipline to wait for those rare, perfect setups that others missed because they were too busy overtrading. Master this patience principle, and you'll have conquered one of the most difficult aspects of trading psychology. I am Jesse Livermore, the man who made and lost 4 fortunes trading the markets. My greatest edge wasn't some secret formula or inside information. It was understanding myself. Rule number 5 of my trading system is perhaps the most powerful yet overlooked tool any trader can employ: the journal method for documenting psychological patterns. When I lost my first fortune of $50,000 in 1901, I didn't understand what happened. When I lost my second fortune of $3 million after the 1907 crash, I still didn't fully grasp my errors. It wasn't until I began meticulously documenting every trade, not just the numbers, but my emotional state, that I discovered the psychological patterns destroying my performance. I created my journal method in 1908, after that devastating loss. Every morning before market open, I wrote my mental state. Every evening, I documented my emotional reactions to the day's trades. This practice revealed something profound. My psychology followed predictable patterns that directly correlated with my profits and losses. I discovered I was most dangerous to myself after a string of winning trades. My journal entries showed a clear pattern. After 3 consecutive profitable trades, my 4th trade would become reckless. I'd increase position size, ignore my own rules, and inevitably give back profits. The journal made this pattern undeniable. Here's exactly how I structured my journal. Each entry contained 3 sections: before, during, and after. Before trading, I documented my emotional state, sleep quality, and outside stressors. During the trading day, I noted immediate reactions to wins and losses. After hours, I analyzed how my psychology affected my decisions. This method saved me in 1929. While everyone else was caught in the euphoria, my journal entries from 1928 showed the same psychological patterns I'd experienced before previous crashes. This self-awareness allowed me to reverse my position and short the market, resulting in my greatest triumph: $100 million in profit during the greatest crash in history. I don't just record trades. I record my thinking. When I feel absolutely certain about a trade, I document that certainty. When I review my journal later, I discover that absolute certainty often precedes my worst losses. The pattern is unmistakable. Your psychology will follow patterns too. You'll make the same mistakes repeatedly until you document them. The market is the greatest psychological mirror ever created. It reflects your flaws with brutal efficiency. My journal method forces you to look into that mirror. I've learned that fear and greed leave fingerprints in your trading record. By documenting these emotions alongside your trades, you'll see how they corrupt your judgment. This awareness alone will improve your results by 30% or more. I guarantee it. Don't just track your trades. Track yourself. The greatest enemy you face in the market is your own undocumented psychological patterns. Master them through rigorous journaling, and you'll master the market itself. This isn't theory. It's how I made millions while others lost everything in 1929.